Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. Entity assumption. Entity assumption is a logical fallacy that occurs when someone treats an abstract concept or a collective group as if it had a concrete existence or a distinct identity. For example, someone might say, "Society thinks that," or "the government wants to," without specifying who exactly in society or the government holds those views or intentions. This can lead to confusion, ambiguity, and oversimplification of complex issues. Entity assumption can also be used to avoid personal responsibility or accountability by shifting the blame or the credit to a vague entity. To avoid entity assumption, one should be clear and specific about the sources and evidence of their claims, and avoid making generalizations or attributions without justification. The entity assumption is a fundamental principle in accounting that states that the activities of a business or organization should be kept separate from the personal activities of its owners or other entities. According to this assumption, the business is treated as a separate legal entity from its owners or stakeholders. The entity assumption is important because it allows for the proper recording and reporting of financial information related to a specific business or organization. It ensures that the financial statements and records accurately represent the financial position and performance of the entity itself, independent of any personal or external transactions. Key points of the entity assumption. Separate legal entity. The entity assumption recognizes that a business or organization has its own legal existence, separate from its owners, shareholders, or other entities. This means that the business has its own assets, liabilities, equity, income, and expenses. Separate accounting records. Under the entity assumption, the financial transactions of the business are recorded separately from the personal transactions of the owners or stakeholders. This separation allows for the clear identification and tracking of the financial activities of the entity. Financial transparency. By treating the business as a separate entity, the entity assumption promotes transparency and clarity in financial reporting. It ensures that the financial statements provide accurate and reliable information about the financial health and performance of the business. Limited liability. The entity assumption is closely related to the concept of limited liability, which is a legal protection for the owners or shareholders of a business. It means that the personal assets of the owners are generally protected from the liabilities or debts of the business. Compliance and accountability. Treating the business as a separate entity helps ensure compliance with accounting standards, regulations, and taxation requirements. It facilitates the proper recording, classification, and reporting of financial transactions, enhancing the accountability of the business. Continuity and transferability. The entity assumption allows for the continuity and transferability of the business. Even if there are changes in ownership or management, the entity remains intact, and its financial records can be maintained and transferred accordingly. Overall, the entity assumption provides a framework for accounting that recognizes the distinct identity of a business or organization. By treating the business as a separate entity, it enables accurate financial reporting, transparency, and compliance with accounting principles and standards. This assumption is foundational to the integrity and reliability of financial information, supporting decision-making processes and stakeholder confidence in the business.